please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
I'm buying the 135 call at 4, stop loss at 2.5.
All right. The markets have just opened and it's about 2/3 of a percentage point higher. 10,500 has been conquered. It's not a huge gain, but it's definitely something that we can take with both hands at least. The Sensex as well up about 200. That's about 2/3 of a percent again. Bank Nifty, of course, is struggling, and that was always expected. To some extent, that will be because of State Bank of India. The initial sell on State Bank of India is to be expected. Actually, even in the oil majors, it is to be expected. So BPCL also starts 0.5% lower, but State Bank starts 3.5% lower. Meanwhile, the mid-cap is running away. That's I'll come to that in a jiffy. But I just want to discuss SBI, 3.5% lower. Maybe pull up even Bank of Baroda and check. Okay, there it is, 4% higher. So a thumbs up for Bank of Baroda. Its loan growth itself was 1 point, which makes its stress look less stressful. And then Tata Steel is the other stock that we should look at. Came out with very good numbers, and that's up 3%. So those are the winners and the losers. ONGC actually is not showing so much strain, though the numbers were not all that flattering. At the moment, it's still higher at 2.9%. M&M again, good numbers, 2% higher.
Okay, the mid-cap index is doing pretty well for itself, up more than 1% right now. A couple of stocks do deserve mention, though, because of the way their numbers have shaped up. Nalco is up 7%. There was some disappointment in the numbers, but I think the street is overlooking that. 7% higher now on Nalco. You have a couple of these other stocks that are reacting to their numbers. So take a look at Amara Raja. It's up almost about 4% on the back of good numbers. Bata reported a good operational performance, so that stock is up in the green. Sun TV saw a very strong ad revenue growth of 22%. That stock is up almost 2.5%. Marico, well, the stock is reacting on the upside now post its numbers, so 2.5% there. Cadila, the Moriah plant has 0.483, so Cadila is actually well in the green, up about 5% right now. And a couple of other stocks like Fortis Healthcare have been in the news. That stock is down almost about 1% or so. In terms of other stocks, some of these names like Ashok Leyland continue to move up. So that stock too is up almost about 1 to 2%. Looks like the buying continues in a lot of these non-index large caps. Manappuram Finance is also up another 2.5%. So Anuj, good opening for the market.
Good opening for the market, but opening right into the resistance zone. So that will be interesting. I think autos and auto ancillary really is the space to focus on. You spoke about Amara Raja batteries. I think the market is latching onto a lot of tire stocks as well. For example, just take a look at Apollo Tires' stock. Again, because a combination of rubber, and crude oil, that having an impact, there's buzz of a price hike as well. So if you see not just Apollo Tires, but SEAT and a couple of other stocks. And, when normally autos do well as earnings, you see that ancillaries do well. And you've seen that play out in Amara Raja and a couple of other sectors as well. So that clearly is one pocket which, I think is right now having a bit of a breakaway gap. So that's something to focus on. But for the market, Sonia, clearly the mid-cap index 7:1. Normally this kind of advanced decline does not sustain. So that's something which could be interesting. SBI as well actually is now off the low point of the day. So let's see. 125 higher on the Bank Nifty. Ashwani, what would be the first trade?
So I think the Bank Nifty is seeing short covering and possibly latching on to lower crude prices, etc. So this is a good time to get long on Bank Nifty. Today's low as a stop. I think you could see maybe 200-300 points higher on the Bank Nifty today because the private bank selling is done. PSU banks don't really count for much, but I would think, given the overall situation on crude, etc., I think Bank Nifty should have upside. But for the day, I think National Aluminium, BOB, Tata Steel, these sort of stocks which have some sort of macro news, they could do well. Also, these commodity consumers like tire, etc., they could move up fairly sharply.
Okay, so what would be your top? Nalco, you said, and what else, Ashwani?
See, Nalco and maybe even Tata Steel, because even after the numbers are announced, the stock is opened higher. So today, metals could do well given the global markets are a bit more stable.
Okay, I just want to mention a couple of stocks. Apcotex Industries, that stock is actually up 20% right now. It is, you know, the promoters of Asian Paints have a major share in Apcotex Industries. If we can get it up for you. It reported its numbers on Friday post-market hours, and the numbers, the earnings for Apcotex Industries were very strong. So that's one stock that's doing pretty well. Both revenues and profits jumped up quite a bit. And the other one is VST Tillers and Tractors. That one too has hit a new high today. Good numbers came in during just after close on Friday, and as we've seen, you know, M&M has also raised its forecast on the tractor growth for the full year. So VST Tillers and Tractors also looking pretty good. So Darshan, any thoughts on any of the broader market stocks? Anything that you like post opening?
Yes, first traders should be long in the Nifty, as I explained in the morning. Your initial stops are 10,450 and raise the stop slowly. There are two stocks now. One is Bharat Forge and the other is United Spirits. Both are look good for buying today.
Okay, Ashwani, on these auto ancillaries, what would be your top pick in the morning?
See, first of all, I think Reliance has opened up about 1% higher, so that could also participate along with the banks. I think Maharaja, the first phase of the rally is done, and now it's the second phase. So possibly you could see 950, 960 on Maharaja, and this has come off a big, you know, downside or bear market. So chances are Maharaja could do well for the next few weeks and months.
Okay. All right, gentlemen, we will of course keep touching base with you again. For the moment, the markets have actually built on to, I mean, it's only 5 minutes of trading, but they've built on to their gains. It's now 3/4 of a percentage point higher, 250 up on the Sensex, 77 on the Nifty, and a 1.2% gain on the mid caps. Then, well, why were you so downbeat? After all, this year also we had a GST disruption. Things should pick up perhaps in FY19. More good reasons. Would you not give the benefit of doubt now that earnings can grow in FY19 better?
Lata, I'll ask you a counter question. Which of this was not known 1 month back? You go and see what the brokerages were saying. They were all saying we will end the year with 16-17% earnings growth. GST did not happen yesterday. It happened 5 or 6 months back. The point that I'm trying to make is that even now, despite low basis and the fact that we have actually had little earnings growth for 3.5 years, we are still seeing remarkable downgrades for the Nifty every quarter, this quarter included, and this quarter will be a massive markdown. So I'm saying the conviction that I hear from a lot of the brokerages about next year, I would be tempted not to believe, because they've got it wrong 3 years on the trot, and they will get it wrong by a very long margin in this current year as well. So, you know, the facts are that every year we are saying next year will be great, so we should be optimistic, but next year it turns out not to be great. So all you have right now is hope. This quarter's current reality is that we'll get 10% earnings growth on a very low base. That is not reason to be very optimistic, saying, but the future looks rosier. I think there's a little bit of delusion or self-delusion in that assessment.
Okay, by the way, CG Power, that's a big order for CG Power, $55 million order for CG Power. Just pull out the stock intraday, and today's you know, earnings as well for CG Power. So that stock has had a bit of a gap up, and after that, this order win that you have, $55 million, is helping. So big move right now on that stock.
Okay. Well, let's wind up this discussion. Udayan, thanks so much for joining us and speaking with us on the markets. By the way, the market is looking pretty good. So the Sensex is up 250 odd points, and the mid caps are doing much better, up almost more than 1% at the moment. Let's invite our market master, Dipen Sheth, the head institutional equities at HDFC Securities, is with us. Dipen, hi, good morning. What have you made of earnings season so far? There have been some hits and some misses, but by and large, were you happy with the performance, or do you think that it's still some quarters away before we see a good recovery?
I think I'll go for the still some quarters away theory. But we are, so I'm not completely in Udayan's camp, let us say, in the sense that everything looks bleak. And yes, brokerages have been thumping the table for 2-3 years now. But we've gone through a lot of transitory pain and changes. And I must confess, we've also missed out on the global growth opportunity that presented itself over the last couple of years, even as we were curing ourselves internally. So now that we are ready, we may not see the kind of global growth opportunity that let us by in the last couple of years, but that's okay. I think in a longer term evolution of the economy and indeed of the country, I think a couple of missed years here and there is fine, so long as structural changes which hold hope for the future were being implemented.
Okay, well, Deepen, just one more macro question and I'll come to more specific stocks. Is there a worry that, up until March 31st, you could have the mutual funds probably at least not buying, keeping their cash because they would like to declare a dividend before the tax strikes on April 1st. So is that a bit of a ceiling for the market? And thereafter, there is a series of elections coming. So would that be a bit of a bother?
Yes, it's a bother. So the political noise is always a bother, but I think we get over it over a period of time. And I don't think that's what I'm worried about. This thing about mutual funds feeling compelled to distribute dividends is driven on the back of the theory that distributing a dividend is tax-free now sorry?
Equity is.
And that after the 1st of April, the long-term capital gains tax will come in. For Christ's sake, Lata, a 10% tax doesn't take away anything from an investment decision. So 10% versus 0% is nothing that bleeds my pocket. I don't think that's the way. I think
I heard it from fund managers that they could declare.
So I don't know if they will, and really I'm nobody to comment if they should. But I don't think a 10% tax incidence is something based on which people change investment decisions. For God's sake, we've had a 40-odd%
only asking for a technical ceiling. I'm not discussing the impact of that 10% at all.
So in case
I'm just asking you if you see this as a technical ceiling.
I don't see
up until March 31st.
I don't see it that way at all.
Okay.
Okay. And if they have to pay out a little bit of dividend and if they conserve cash for that, then they'd better get over with it quickly. But I don't think they have the mandate to sit on cash.
Okay. Deepan, good morning. So, is there a good chance that once the global stability comes back, I mean, of course, that's a big,
big if.
Big if. In that case, how much do you think the market can gain this year? Last year was a stupendous year, but in last bull market also we went through 2 or 3 years of consolidation, of one rough year of consolidation or even negative growth. So, what kind of return should investors expect this year?
So first of all, let's understand this equity animal, okay? So it's the nature of the beast. It's a volatile beast. And for the last 13, 14 months, we were seeing virtually no volatility or misbehavior by this equity class. Equity, so let me put this in the most controversial way possible. Equity was pretending to be debt. We were lulled into believing that the stock market is a 30-35% per annum fixed income instrument. And that had to give way, whether it was globally or whether it was in India. And the fact that we went up, about 12 or 13-month returns on the Nifty at the end of Jan were close to 40%, 38-odd%, 53% on the bank Nifty, 52% on the mid-cap Nifty. I mean, what are we talking about? We were sleepwalking all the way to the roof and we would have fallen off the roof. So I'm happy we fell a little earlier and we just crashed down the stairs, which is okay. So first of all, let's get that out of the picture. Now, what can happen in the next 1 year? I really don't know, but we've had such a stupendous year that if nothing happens in this year, if we are in, single-digit positive or let's say even negative returns, it wouldn't surprise me as an observer of equity. It would be disappointing to see negative returns, of course, when there's so much promise on the table. Okay, but we are coming off a crazy year of returns, and I think this is the time that the SIP wallas are going to be tested for their patience. This is what SIPs are made for. You go through a bad year or an indifferent year, you hang in there and keep doing your SIPs. So for all those people who think that their job is not to time the market and they're not as smart as, let's say, Lata and Anuj or whatever, so they can just hang on with their SIPs. And that's the sensible thing to do across cycles. This is one of those things in a cycle. Equities are cyclical.
I do the dumbest thing.
We do it by force.
I invest simply in mid-cap ETF because, I don't even have, the mental space to look through individual funds.
And we get so much information that we just purely invest in
okay,
mutual
funds. I want to come to the two sectors, IT and pharma.
Yes.
First, pharma. I mean, you've picked up Cadila in Torrent. You're not picking up any of the bigger fellows.
No. So so let me put this on the table. The disclaimer is that we've gone horribly wrong on Lupin. Okay, so The bigger picture about both IT and pharma, and this is the old record playing all over again, these are run by India's smartest brains. These are two industries or two sectors which have competed successfully for decades against global competition. Our most capable people run IT and pharma companies. In fact, some of our cleanest promoters run IT companies, as also pharma, right? You can't be a long-term bear on these guys, and every time bad things happen to good businesses and good people, you start sniffing around for value. And that's all we've done. There's nothing extraordinarily, insightful here. Okay. Now, if you'll see, all the large cap ITs have also run up, but the performance is all happening in the mid cap IT space, right? So the large cap IT guys haven't had a great quarter. It's just been an indifferent quarter. You look at the TCS or Infi numbers, they're making the usual noises. They are going at about 1-2% sequential growth here and there. But the mid caps have exploded. And in fact, it's this time, the funny thing this time is that the mid caps have pulled up the large caps purely in re-rating terms. And hell, we're just seeing the beginning of dollar strength or rupee weakness. So the party has just started. I don't think it's over anytime soon.
I wanted to discuss particularly about some stocks like Cadila, because we've been getting increasingly good news. Their facilities have been checked time and again, and no observations, etc. Is there still a lot more to go in names like these?
So specifically, Sonia, on Cadila, this has been our top pharma pick for a while, okay? And this is probably the only large cap pharma company which has no known regulatory worries, and it's been that way for a while. And they've come off of, in fact, they were the first people to run into regulatory hassle some 3 years ago or something. And unlike the rest of the industry, they don't have any worries on the regulatory front, and they have a fat ANDA pipe. Okay, if you look at the 3Q numbers, of course, there's a little bit of a blowout because there are exclusive or limited competition products like Lialda or Tamiflu, the generic versions which they launched. So Lialda was an exclusive, Tamiflu was limited competition. And obviously competition will now eat into these products and there will be price erosion. There's also a little bit of an extra cautious generics price erosion commentary by the management. We're not too worried about that because more launches are coming, especially in the limited competition space. So there are at least 4 that we know of, including generic Exelon, which is a transdermal patch. And so there are going to be 10 or 12 new launches every quarter in the US market from 4Q onwards. R&D spend is close to 7-8% of revenues. I can see 16-17% earnings CAGR. So part of fat earnings fall off because of competition coming in, but new products come in, and again you have hotshot products coming in, and there is 16-18% earnings CAGR over FY 17 to 20, and about 17-18x multiple looks very, very interesting.
Okay.
Let me.
I just wanted to ask, last year, I think it was 2 years back, you were very bullish on this chemical space, the likes of SRF, Navin Fluorine. Has that story played out? Is there anything else that you are liking?
There's still more things playing out there. Now there are 2 interesting things. One, when we spotted chemicals 2 or 3 years ago, it was obviously a neglected part of the market, and people really didn't understand the linkages across chemical products and how they feed into macro growth. So it was more of a getting started. At this point of time, I think the important thing to look at is that and I will refer to a comment made by someone very senior in the market, in which he said that China has stopped exporting blue skies, okay, which means that China is cutting down on domestic pollution in a big way, just so that it can supply certain products at a heavy profit to the rest of the world. Now, this is also a trend which is about 2 or 3 years old, but it has picked up momentum mostly over the last year and a half. And a whole lot of small chemicals manufacturers in India are getting the advantage of this. So the stories in fluorine and all that are well known, but there's a whole lot of people in the dyestuff space, in the specialty chemical space, who are going to benefit from this. So recently, for example, and I must confess it looks like we are a little late to talk about these stocks, but we've identified a subsector within chemicals, which is the amines sector. And we've covered both Balaji and alkylamines. And we are very constructive, although much of the re-rating arguably is over. But I think the earnings grow out and the reinvestment in both businesses is at a stage where we think that for the next 2 or 3 years, they are pretty much in a sweet spot, and stock returns could at least mimic earnings growth, if not offer a complete re-rating.
As a citizen, I don't like the idea that we are making chemicals which are
no, so it's interesting, Lata, that it's not that Indian chemical manufacturers are not compliant with the local emission norms and so on. So both Balaji and in particular alkylamines are definitely on the right side of the law.
Okay. I mean, it's just that standards could be tightened, but that was a different issue, more social. What about IT? And in particular, I want to ask you, at the moment, First Source is flying away 6%. Do you have a coverage on that stock?
No, we don't. But I think the larger picture again in IT is that we were all as an investing community. The community was kind of very negative on IT. So there is this big automation, and digital revenues are not taking off for Indian companies, and automation in AI will take away jobs, and there is a visa issue in the US, and demand is falling off, and you know, the US corporate spend cycle is going nowhere, and the US has 2 good years of growth, and pricing power comes back. And meanwhile, even as the rupee was hardening, Indian companies were assiduously working to increase efficiencies. Most of these guys were at early 70s in terms of utilization. Now, I would be very surprised to see any company which is less than 80% utilization, ex-bench. Sure. Right? A lot of these people have invested aggressively into digital. A lot of these people have shifted their onshore and on-site and offshore service mix. A lot of them are getting into new parts of the business and with new service and product offerings. So I think Indian IT has responded magnificently to the challenge. And now what's happening? You have a currency tailwind which is favoring them. You have mostly repaired businesses which are now ready for the takeoff. Okay. And it's reflected in the way the mid-cap IT guys have run up some 30-40% in the last 3 months.
Oh yes, in certain cases even more than that. And thanks a lot for your time, Deepan. Always good talking to you. That's a view from HDFC Securities. The market, by the way, is at the high point of the morning. 75 points higher is what we have. Bank Nifty up 150 points higher. Nowhere near the indication that SGX Nifty was giving us. And in fact, that is, of course, a big story. In a bid to end SGX Nifty and Sensex futures trading abroad, Indian exchanges have come together and have issued a press release. Henceforth, they'll not provide data on Indian indices or stocks to any foreign exchange for trading derivatives. Surjit Bhalla, PMEAC member, is now with us. Mr. Bhalla, good morning. Your thoughts on this, because you know a lot of people are saying that it's a bit of a retrograde step. In a free economy, kind of environment, to have this kind of restriction. I wanted your first thoughts.
Yeah, first let me make it clear that whatever I say, they are my personal views. Sure. And have nothing to do with whether I'm a PMAC member or not. Strictly personal views. Sure. You know, I've done a lot of work on the capital gain side. I haven't done that much work or research on this new initiative. And plus you have today in the papers that perhaps the SGX will tie up with the gift city. So if I were to take a bird's eye view, it looks like the government is trying to get people to come to the gift city. But we'll see how it plays out. This is, in one sense, you know, the other thing in the budget is increase in custom duties, etc., which is also smacking of protectionism. So we'll have to wait and see as to how protectionist the government becomes and what are the arguments for imposing or getting SGX to collaborate with the gift city.
Okay. Good morning, Mr. Bhalla. Thanks much for joining us. Yes, these are your personal views, but will these have any other repercussions? In the sense now, this morning there are fears that India could get a lower weightage in the MSCI indices because of, you know, some restrictions on foreign participation in Indian indices. Are there collateral damage that we will see?
Well, we'll have to wait and see. You know, it is, I think, one argument which I've made and I'm making, that the imposition of the long-term capital gains tax doesn't provide you with much revenue. So why are they doing it? I think that hurts the image and the destination theme of Indian stock markets or Indian equity markets. So this is, you know, we are in a very, very competitive world. Things are completely globalized, as you all know, and we've been discussing for at least a decade. And I think it's very difficult for a country to chart out a protectionist course. And in my view, that's not advisable. We'll just have to, as I said, on this thing, whether it has repercussions or not, everybody will take a view in totality about the Indian stock market, including the imposition of long-term capital gains tax,
so, Mr.
as
Bhalla,
well as this sign of protection.
Sure.
Yeah.
What do you think the options could be henceforth in order to protect the existing customers? Do you think there could be a possibility that, you know, SGX collaborates with NSE to start its own, you know, India-focused derivative product? I mean, you spoke about Gift City, etc. You spoke about it, but do you think that's a possibility?
Well, you know, today in the papers there is a sort of discussion that the SGX might get a license from NSE to operate via the Gift City, and that, you know, brings in extra revenue, I guess. You know, something that I've been talking about, and I've talked about on your program and other programs for the last decade, we heavily disprotect fund managers in India. Why that is not going away, I don't know. So, for example, all the foreign investment firms, they manage portfolios on Indian equities from outside of India, get the fees, get the management fees, etc. And we disprotect our own fund managers in India because it's you're not allowed to, other than now perhaps possibly through the Gift City, to invest in Indian securities on behalf of foreign clients. Why is that not changed? I mean, so I don't know. This is, you know, the securities market in India, the financial markets in India. Sometimes you go out of your way to provide protection to the foreign investors, and now you're trying to find protection to the Indian investors or the Indian exchanges. So I think, you know, the government needs to look at this in some detail to have some consistency in what they are advocating.
Oh yes, and Mr. Bhalla, you know, I agree, and this is your personal view. And you know, in the past, I mean, of course, you have been an investor in the market as well. You know, you run a very successful firm yourself. You know, one view is that, like it or not, this is about taxation. You know, there's an STT which takes away. I mean, it looks small, but because it's not allowed to be offset, you know, against your income, you know, that's the big reason that a lot of volume has shifted offshore and may still continue to shift offshore, whether you provide data or not. Would that be a valid argument?
Well, look, I go back to the Kelkar Committee report, Task Force report, which I contributed back in 2002, 2003. And what that report had advocated was no long-term capital gains tax. The imposition, and the short-term tax rate was brought down from 30% to 10%, and the introduction of the STT. It turned out the reason I advocated that then is that a lot of countries, a lot of exchanges around the world in the developing countries have imposed this as a very easy way to collect revenue, to provide some taxation, and, you know, provide, if you will, attractive possibilities for investment into their markets and get revenue. You know, the amazing thing, so I think that is done by all, you know, there is no place in the world where you don't have taxes on either, you know, short-term security, STT, or long-term tax or short-term tax. The question with taxation is that we should separate morality, you know, okay, let's go get the rich guys, from efficiency. The goal of anybody making tax laws should be to maximize tax revenue. Now, if it means that what you impose decreases the attractiveness of your market, you're decreasing your tax revenue. Now, the long-term cap, you know, it's interesting to note the following. The long-term capital gains tax was 20% back in 2002 when the Kelkar Committee report came up, and where they advocated doing away with it. At that time, the estimate was that long-term capital gains tax revenue would be 1,000 crores. Okay, so this is from the Ministry of Finance. They obviously have done the research. They came up with, that's the revenue you would get. At 20%, that's 500 crores at 10%. Okay. The stock market has gone up 10 times since 2002, okay, from 3,200 to 32,000. Now, the total tax revenue that you would get from long-term capital gains tax is somewhere close to 5,000 crores. And, you know, you're getting 7,000 crores, and now next year it's estimated from SCT of 11,000 crores. So I don't understand, and that from the revenue side, how is this advocated, or why is this advocated? It just, to me, does not fit the revenue maximization bill. Okay. And it, second, the tax revenues that are obtained are way, way outlandish from what I understand. Mr. Bhalla, so I think we need to have this.
No, I take your point on that, but I just wanted your view back on the issue that we're discussing now, the SGX Nifty probably ending as a product. If the Nifty, if the NSE were to offer Nifty futures round the clock, say early morning from 6:30 and up to late evening, say 11:30, would that kind of resolve the problem? And by the way, do you think a Gift City index will get buyers, will find an audience?
Okay. This is a good question. Look, I don't know. There are various reasons why Nifty Nifty in Singapore is a very popular product. Okay. So we need to investigate why is it just the timing? I don't think so. I think there are various things about taxation. Now, Singapore is a very, very clean tax environment, and so therefore, all the investors come in there and rather invest through that, rather than come through the Indian. If the Gift City environment is there, I don't know what the view would be, or how that the tax authorities would handle in terms of their books or whatever. So there's corporate governance is writ large on the reason, or I think the major reason for people finding Singapore attractive is the corporate governance there. And obviously taxation helps. But, that's so if they moved it to 6:30 to whatever, I don't know how much we'll gain. I think the solution that is being suggested is that they operate through the Gift City and operate in Singapore. It seems that might be a win-win situation. Doesn't change anything other than your trades are technically going through Gift City, which is fine. We'll get revenue that way. And at the same time, I would ask the authorities, Ministry of Finance, SEBI, etc., why don't they open up our markets to foreign investors, individual investors? In India, you can invest up to $250,000 overseas. Why don't we open that to the foreigners, that they can invest in the Indian markets, $250,000? So I think we need to rethink this has provided, I would say, by the Ministry of Finance, by imposing the long-term capital gains tax and telling the agencies or the exchanges to go ahead and stop Singapore. I think this has opened up a very healthy debate. I hope. I don't agree with the decisions, as you know, but it's opened up a debate, and I think we should have a very constructive debate on this as to what makes sense and what doesn't make sense, and in particular, concentrate on the revenue side, and therefore the other side being the incentive side for investors.
Fair points.
India is not. We can't assume that people will come here forever, or will find us more attractive than others. We need to compare ourselves.
Oh yes, Mr. Bhalla. Thanks a lot for your candid views, sir.
And of course, we are going to carry on this debate through the day and through the week.
And as I said, let's have a healthy debate on this, obviously, because a lot of this is boiling down to taxation.